Hey soldiers, one way rich people get rich and stay rich is because they avoid as much in the way of taxation as legally possible. Legally, I want to emphasize that. There is a fine line between tax avoidance and tax evasion. You don't want to evade taxes. Hell no. No. You don't want to do that because the IRS is nothing to play with. So we're going to talk about those strategies that are legal, that are in the tax code, that allow you, just like the rich people that wrote the law, also allow you to put more of your money to work and pay less in taxes. We're going to go over 3 ways that you can do that. Okay, now, I'm not your tax advisor. I'm not your CPA. You need to consult with them and see if these 3 ways apply to you. They probably do, but you need to consult with your professionals before you make any moves. And just because I know you're going to do that, because you're serious about achieving and maintaining financial independence, I'm going to give you a 4th. We're going to have a bonus at the end of this. You have got to legally avoid as much in the way of taxation and then put those savings to work for you. That's how you get rich. That's how you make money. That's how you pass on generational wealth. Okay? So, without further ado, let's get into it. All right, soldiers, let's get right into it. Number 1, never sell assets. If you don't sell your assets, there can't be any capital gains taxes to levy upon you. Now, I know what you're saying. I'm acquiring these assets in order such that they can make money for me, and then I can take the money and go do things with it. Well, guess what? As of right now, if you borrow against the value of your assets, that loan is totally not taxable in most situations. Check with your CPA to see if that would apply to the assets that you hold currently. Now, this is a long-term strategy. Again, working with the IRS rules. You're not trying to beat them. You're working within their structure in order so that you can avoid lots of taxes. So this is a long-term prospect because you got to acquire the assets. Now, we're going to get to one of these, which should be the one where you're deriving a lot of your income from, your income to live and pay bills. Now, you don't want to be in a situation where you have to sell off assets. Don't you want to bequeath or pass those on to your heirs so that they can continue to enjoy the type of lifestyle that allows them not only to decide for themselves what they want to do with their lives, but also enrich the world by not having to go to a 9-to-5 job every day, by having the ability, like the Kennedys, to get up and create foundations and do good works that, help the broader aspect and portion of humanity. So, as you acquire assets, don't sell them. Now, there are also techniques within that. Let's say you purchase some real estate. There is such thing in real estate as a 1031 exchange. That 1031 exchange allows you to purchase a piece of real estate, and when you sell it, instead of paying taxes on the sale, if you transfer those proceeds into another piece of real estate, you quite probably can avoid a lot of taxation. Now, it's going to depend on some variables. Again, check with your professionals. But the 1031 exchange is out there to help you benefit from owning real estate. All of the benefits that come with that purchase, leverage, tax benefits, appreciation, depreciation, all of that. And then there is a provision within the tax code that allows you to actually sell it, buy another property with the proceeds, and avoid taxation. It's called the 1031 exchange. There is a 1035 exchange, and that's another benefit that allows you to transfer one asset to a more valuable asset within the insurance realm. Remember, insurance, it's not just for when you die. The primary purpose of it benefits you in the here and now, certain types of policies, okay? We're going to talk about that in a moment. But that's number one. As you acquire assets, just don't sell them. To give you a perfect example, if you have a piece of property, you can borrow against that, the equity in that property. And borrowing against the equity in the property allows you to maintain the asset, but just take some of the value out of it in order for you to be able to do different things. And of course, you want to pay that back because you want to maintain the ownership. So talk with your CPA, talk with your tax advisor, see if not selling assets could be a bona fide way for you to avoid a lot of taxation. Number two, I want you to consider maxing out your qualified plans. What is a qualified plan? 401k, 403b, traditional IRA. Maxing out those plans allows you to realize a tax savings right now. So let's say, for example, that you have, you make, $100,000. We're just going to make the math easy. So for the plan year of 2022, income can be reduced for contributions up to $20,500. So if you're making $100,000, then what you'll be able to do is declare $79,500 of taxable income because you would have reduced your taxable income by $20,500. The IRS is allowing you to do that in the 401k plan and the 403b. Now, when it comes to the IRA, the traditional IRA, maybe you don't work for a large corporation and you don't have a 401k. Maybe you work for a smaller company and they don't offer these types of benefits. Well, you can contribute up to $6,000. Now, if you're 50 or older for plan year 2022, you can actually contribute up to $7,000. All of this needs to be talked about with your tax preparer so you can get the details that apply to your situation. But you'll still be able to reduce your income by, let's say, the $6,000. So take our example again. You're making $100,000 and you'll go ahead and contribute the maximum to your traditional IRA of $6,000 in 2022. So now you're only going to be taxed on $94,000. And these are just examples, okay? All right, so max out the qualified plans. Now, you got to be careful because remember, these are qualified plans. They are tax deferred plans, which means the IRS and the government, they're going to give you the tax break up front in the here and now, okay? They want their money when you turn 59 and a half or older and start to withdraw funds from those plans, okay? Or if you take early withdrawals prior to 59 and a half, they're really going to get you because they're going to say, we made a rule so you can put this money away for yourself for your retirement. You took it early, prior to 59 and a half. So not only are we going to hit you with the taxes, we're going to hit you with a penalty as well. So that's going to seriously deplete the amount of money that you have available working for you if you put the money, if you take it out prior to 59 and a half. And even when you do that, you are going to be subject to taxation. So is there anything out there that would allow you to put in money that's already been taxed and then be able to avoid the tax down the road later on when you go to access the money? Yes, there is. And we're going to talk about that. But before we get to that, let's talk about number three. Number three, start your own business. Do it. Now, I talk about this a lot on the channel, but starting a business will allow you to realize a lot of advantages insofar as taxation is concerned at the state and federal level. Now, when I say start a business, I mean start a business, a real business, not just something to give you tax savings. What's the sense in that? You want to start a business that's going to allow you to create a whole nother stream of income. And on top of that, as icing on the cake, as a bonus, you'll be able to also realize tax savings thanks to governments, state and federal, saying, you know what, look, your business could potentially provide some jobs. If you're in real estate, maybe you're rehabbing properties, it's providing housing. The government is not good at doing those things, okay? Providing jobs and housing and, building cars and all of that sort of thing, okay? So whatever business you're in, the government doesn't want to be in that business. And we don't want the government in that business because they are terrible at running things, as you just look around you, okay? And you've got plenty of evidence to that effect. So if you start a business, you'll be able to deduct expenses associated with that business. And that's absolutely huge. Now, you've got to play it straight. You've got to, the best bet for you would be to, if you don't have one already, if you're going to start a business, you need a CPA, a certified public accountant. And that individual can help you build a strategy around tax savings and taking advantage of all of the provisions that are legally allowed for you to be able to save on taxes. Strictly by following Internal Revenue Service guidelines, a business owner can deduct even part of their home expenses with home office deduction. There's a lot in the tax code. There's certain tax advantages that allow you to deduct large portions of the price of certain vehicles even, okay? All right, so those are 3 ways that you can avoid taxation. Hold on to your assets. You're going to want to do that anyway because you're going to want to pass on generational wealth. And even if you don't have kids, wouldn't it be nice if you passed on that wealth to maybe nephews, nieces who, are doing good things, or maybe even foundations that are in line with your way of thinking, okay? Those are options. And you could do those things and benefit your kids if you've got enough money, and that's what we want you, that's the position we want you to be in. So don't sell assets. That's one option. A second option is for you to go out and contribute to your qualified plans. Max those plans out. 401ks, traditional IRAs. There is also a Roth IRA. Okay, get to that in a second, because that works a little differently. But the other thing that I want you to think about when you are contributing to a 401k is if your company is matching, if they're actually matching what you're contributing, then that's definitely something you want to get in on, because that's basically who wants to turn down free money, right? All right. And then number 3 was starting a business. Okay, I promised you 4, and here's the 4th one. A vehicle that's going to allow you to put in money that's already been taxed. A vehicle that's going to allow your money to grow tax-free. It's going to allow you to access it tax-free. And it's going to allow you to pass it on to your heirs or to organizations you care about, or both, tax-free. What is that? It's the properly structured permanent life insurance policy. That's right. The IRS has built this whole structure around allowing you to have those 3 benefits: tax-free growth, tax-free access, and tax-free distribution to your heirs within the structure of a permanent life insurance policy. A lot of wealthy people have these for the reasons I just mentioned. Wealthy people know how to build their wealth by avoiding taxes. So the other thing with that is this. Let's go ahead and put up the national debt clock, okay? Now, as you see this thing running, it ain't stopping. It ain't slowing down. It's speeding up. So is it a safe bet to think that at some point the United States government, I don't care which party you're affiliated with, Democrat or Republican, at some point they're going to have to raise taxes, right? Okay, we agree. So wouldn't you rather pay taxes on money now when the tax rate is lower than later when, in all likelihood, it's going to be higher? Now, I'm not saying that you need to exclude other vehicles that give you the tax savings right now. I'm not saying that. But wouldn't it be great to have a pot of money that is insulated from future taxation? I believe so. So, consider all those things. A properly structured permanent life insurance policy can give you all of those benefits. And it also is going to allow you to max out. This is another thing you can max out, okay, annually to get the peak performance out of it. So it takes, a lot of moving parts to build a successful vehicle and get you on the road to financial independence, keep you on that road to financial independence. So consider those things, guys. It is up to us to be able to use what's in the tax code to legally avoid taxation and keep our money growing at a really prodigious clip. Okay, guys, I'll talk to you soon.